the agenda that we have today is really to discuss the economy, discuss the corporate environment, discuss sentiment, market positioning, and then everything that's going on out there, try to really put it all together to form some type of view of what to do now and really what to do next. Because the way this sell-off has come very, very quickly and very, very aggressively, it can leave a lot of people wondering what's actually going on. And there's a lot of information that I look at, and I really wanted to put this into a really into a little bit of a slideshow to kind of walk through the process of the different things that I like to look at in order to form an opinion on what is really going on. Because there's a lot of headlines, there's a lot of negative news, and sometimes it's hard to decipher what's really going on. And I really want to put that into perspective. So first off is the economy and why we focus on the economy. And the reason is because economic recessions lead to longer and deeper bear markets. Now, it doesn't mean you can't have a bear market without a recession. It's just that they tend to not be as long or as deep. So, in fact, there's a statistic where only one of the 11 pullbacks greater than 10% since 1976 have turned into bear markets, although 1998 came very, very close, and that just happened to be 1987. So if you look here at this chart, it actually breaks down the gray bars are recessions, the width being how long they last, and the blue bars being the width being how long they last as far as recession, and then the length of it being how deep that recession is. And as you can see, I'm sorry, that's how deep the bear market is. As you can see, the larger bear markets back in the 1970s, in 2000, in 2008, all were accompanied by recessions. And the one lone skinny bar in 1987, while it was a deep correction and a relatively deep bear market, it was very, very short-lived. And I'll show that to you in a second. So the 1987 bear market lasted 4 months from peak to trough and dropped about 33%. Now, the interesting thing is that the majority of the losses actually came in one day, which was almost 23%. So most of that loss was in one day. And even though the market didn't bottom or retested the bottom in December, between August and October, it's only really 2 months where you saw that downside. And that happened on Black Monday. It's very, very famous. And this is the one true bear market that happened outside of a recession. As you can see, with the return in the stock market from December going forward, while it didn't recover all of its losses over the next year, it did recover about half. And at that time, it was not a good time to be panicking, and actually in a good situation to be holding your positions. Next, I wanted to look at the 1998 near bear market, where we dropped about 19%, and this lasted about 3 months from peak to trough. And so the interesting thing with this bear market was this came from a really a time where we were in the midst of a long bull market. There was no recession. However, at this point in time, really, the Federal Reserve actually did cut rates, which is why you had the very, very quick recovery. And I felt that was important to talk about right now, because the last leg down in the stock market this week happened when the Federal Reserve basically came out and said that they're going to hike, and they're expecting 2 more hikes as opposed to 3 next year. And many people were expecting them to stop and say, we're just going to wait and see. So let's take a look at the current economic backdrop, because, as I said earlier, the big bear markets happen with economic recessions. And so what this is here is a look at the leading economic indicators. And what this is the Conference Board takes a look at 10 different leading economic indicators, and it's used to predict what the economy is going to do in the near future. So other than 1987, all the big corrections came after the leading economic indicators turned lower. So in 2016, they were almost zero. In 2007, they were approaching zero. Back in 1998, they were actually approaching zero as well. And as you can see, back in 1987, they were still relatively strong. If you look at where we sit today, at the level of 5.2, it's come off its high slightly, but still sits very, very close. Outside of a few times, it's still in a very, very strong position, meaning that while there can be some weakening in the economy next year, you just don't typically see a move to recession from these highs of levels in that quick of a time period. Next, you want to look at the unemployment, because unemployment usually troughs before a recession. Now, there's been a lot of talk that unemployment, it's a lagging indicator, and the unemployment rate can be somewhat manipulated in the fact that it's a function of participation. So if nobody's participating, then you can, or a lot of people are participating, it can change that unemployment rate. But as you can see, back in the early 1990s recession, the unemployment had troughed out. Back in 2000, it had troughed out. And back before 2008, it had done the same thing. And where we sit currently, the unemployment rate is still falling, and the employment is still fairly strong. So next, because the unemployment rate can be manipulated a little bit, I wanted to take a look at jobless claims, because this is just very simple. If people are filing more jobless claims, then the number goes up. If they're filing less, it goes down. And as you can see, before each of the last few recessions, this number had bottomed out and actually had started to rise. Bottomed out and started to rise. Every single one of them, it bottomed out and started to rise before a recession. And as you can see where we sit today, this number, these jobless claims are sitting at record lows, and they are continuing to decline. Now, I don't want to say that it's all rosy, because at some point it can only get to a certain level. There's only so many jobs that are available. And so I would expect that this can't go too much lower. However, it is continuing to maintain that and hasn't really turned up at any period yet. Next, I want to take a look at the manufacturing. This is another indicator that usually slows well before a recession. So if we take a look at these green arrows before every recession, it had peaked years before the recession happened. In 2000, about a year before the recession happened. In 2000, going into 2008, this was several years before the recession happened. And in fact, you will see there, it does move up and down, and there are times when it moves lower, and this just happens to be a soft patch in the economy and not a recession. But if you look here, back in 2011, which is the red circle, and 2016, which is the red circle, which were two very, very large corrections that we had in this bull market, the manufacturing had slowed significantly. So 50 is the level. Anything above 50 is considered expansionary. Anything below 50 is considered contractionary. Both of those times it was contractionary. We're sitting right now at 59.3. Which 60 is about the level where you can sit where it peaks. So again, this is showing a lot of strength. Now you can say it's probably peaking out, but you shouldn't go from a peaking out near 60 to a below 50 in the next few months. It just hasn't ever happened before, and with the way the market's going now, it's predicting that it will happen. And I would like to go with history on that. Next would be the service sector. So there is argument that our economy, which was once built off of manufacturing, has moved more to a service sector economy. And in fact, this time series here actually only goes back to 1997, because prior to that, manufacturing was considered the most important, and then they started to move and say, well, we're more of a service sector economy, so we should probably start looking at that. So while the data series is not quite as long, it does give you some perception into what's actually happening. And as you can see in the last two recessions, service sector had dropped pretty dramatically inside the recession and had peaked somewhat beforehand. And as you can see here, basically since we came out of the Great Recession in 2008, we have been accelerating and are now close to near highs. And so this would be, again, be a very, very dramatic turn lower to put us into recession at some point early next year. So rather than paint all of the rosy things that I see in the economy right now, I want to be realistic and say there are some things that are concerning to me. And you have to take a look at every piece of information that's given to you and try to put it together. So here we have new home sales that goes back for several years. And as you can see, obviously, before 2008, we had a huge, huge increase in new home sales. That was part of the bubble. That's part of what cracked and caused the Great Recession of 2008. And as you can see, it bottomed at historic lows, and we've only recovered a portion of that, and probably really more in line with what you saw in the 1980s. This number has easily peaked and started to come down. And so while home is an important part of the economy, it is not as much as it was back in the 90s and 2000s, probably going back to 1980s or even 70s. It's probably that important. And it has peaked. And that will be a drag on GDP, just not quite as much as it was in the 2000s and 1990s. Next, another area of the market would be auto sales. And as you can see here, this is not quite as much of a leading indicator. In fact, if you look in early 1990s, the big fall in auto sales happened during the recession. And same in 2008, the big fall happened during the recession. But the capacity that we have in the U.S. for auto sales is really at a maximum is between 16 and 18 million cars a year. We have been at peak auto sales really since 2016. And we have hovered between that 16 and 18 million level for a while now. And I wouldn't expect this to significantly drop until after a recession hits. So we may be at peak auto, we may be peaking as far as the economy is concerned, but nothing is so alarming that says, hey, we're going into a recession within the next 6 months. Another part that I'd like to look at is freight shipments. And this is a measure of global business. And because even though the U.S. is the biggest economy in the world, it is not in isolation, and there's other factors involved. And so freight shipments, it takes a look at this information. So you can see, obviously, freight had gone up dramatically in 2017 and really peaked at the end of last year and has come down pretty significantly since. Now, the reason why that spiked so much is we had really the first global synchronized economic recovery in 2017 that we'd had in a number of years. And that's why it got so high. So the fact that it came down is not too surprising. But we're still really not back to the level that we saw between 2013 and 2016. So again, it shows a slowing in global trade, which again is not surprising given the tariffs between us and China and talk between us and Canada, Mexico, and Europe. That is going to cause some issues, and it will slow things because there's some uncertainty there. So again, not a surprise, but still, if you go back from 2013 to 2016, we're not quite at those levels yet, and those were good years for the stock market, and we never saw a recession over those years. The next thing would be interest rates, and these are very, very important because interest rates are a very good predictor of the economy and a very, very good predictor of what people are expecting. And here, this is the yield curve, and it's the difference between 10-year treasuries and 2-year treasuries. And the reason why this is important is you can see is every time that we've inverted, meaning you get paid more money to hold a 2-year treasury than a 10-year treasury. Every time, back in the late 80s, in the early 2000s, and also in 2000, really between 2006 and 2007. After we inverted, we were in recession within a few years. And so the reason why this is such a good predictor is because, one, there's market forces involved, but two, if you're a bank and banks are lending, they borrow short-term interest rates, so they borrow we'll just call it 2 years, and they lend at long-term interest rates 10 years. If there's not much of a spread, then, or if it doesn't make sense for them to lend money, then that can tighten up credit, which then causes a recession, which then leads to the Federal Reserve cutting interest rates, and you can see the yield curve steepens, and eventually you come out of that. But what's interesting is, in at least the last 2 recessions, the time when the stock market really got hurt was when, after an inversion, when the yield curve re-steepened. After an inversion, when the yield curve re-steepened. And that, again, as I said, comes along with the Federal Reserve cutting interest rates, not raising interest rates. And that's very, very important to take into consideration when you're thinking about the current environment and what the Federal Reserve is doing right now. Additionally, as we take a look, so right now we're at, it's pretty flat at 12 basis points. If you go back to this level here, 1998, we were pretty flat and very, very close to that. And actually, the late 90s, we stayed pretty flat for a number of years before we actually inverted. So even though we have been flattening for a number of years, we are flat, we can maintain flat, and until it inverts, there's still room for growth in this economy. So I would say flashing yellow, not flashing red yet. The next part of it, of interest rates, is the amount of credit risk that's in the market. So this is a chart that looks at high yield spreads. And as you can see, again, before each one of the last 3 recessions, high yield spreads, each red arrow shows that high yield spreads started moving higher well before the actual recession. And the reason why, so basically what spread is a high yield bond is the riskiest of risky companies in the U.S. So if you're an investor, you're going to want to be paid a lot more money than a treasury, than a U.S. government bond, to be compensated for that risk. And so when spreads widen, that means you're requiring a lot more interest to hold that risk. So when they widen, it typically means that there's more of a chance of default. And when they contract, the economy tends to be doing better, and there's less of a chance for default, and you're willing to take lower yields because you just think that this is a good bond and it's going to continue to do well. Now, the interesting thing about this widening, now the last red circle here on the right, it obviously has started to tick up from record lows that we saw earlier this year. However, if you look at the other 2 red circles, it is nowhere near where we got in 2011 and where we got in 2016. Additionally, these high yield spreads started to move in 2011 and 2016 well before we had the corrections in the stock market. In this instance, recently, we had the stock market sell off, then high yield spreads ticked higher slightly, and then oil started to collapse. And that's what caused the high yield spreads to really jump in this last case. So high yield wasn't the first mover, which has happened in the past. It really was a function of the other things that were going on in the stock market. So because we can't look at the U.S. in just a bubble, you want to take a look at the international backdrop as well. And so here's a look at the Eurozone. It's Purchasing Managers Index, similar to the Manufacturing Index that I talked about here in the United States. And this is fairly obvious that this number peaked in early 2018 and has really come close to is getting fairly close to contraction as we sit today. Now, that is going to be a drag. Obviously, there's no longer a global synchronized growth. We saw that, as I said earlier, in the shipping index. And so this is obviously a concern. And I would expect that to cause some slowing in global growth and some slowing in growth here in the United States. However, if you take a look, Europe was in a recession between 2011 and 2012. And we had a very large correction in each one of those years. However, we never went into recession, and we did recover and come back. And so, while there are some issues in the Eurozone, the Eurozone is small compared to the US and China, and right now I don't necessarily expect it to have us cause a recession, even though I would expect it to cause some slowing in GDP. Next, we want to take a look at the other elephant in the room, which is China. And while it's always difficult to extrapolate some of the government data that you get from China because you're not sure exactly how correct it is or if it's manipulated at all, it is still good to take a look and see what's going on. So here's a view of Chinese industrial production. And as you can see, back in 2008, it collapsed and then rocketed higher back in 2009 and 2010. And it has slowly come down and stabilized really for the last 3 years at this level about 6%. Which if we had 6% here in the U.S., we'd be thrilled, and we'd be running laps around how great the economy is doing. And just recently, as you can see, we had stabilized around this level and just recently started to drop a little bit further. Not surprising, again, as the economy matures, but still not good to see it drop, and it's probably a result of the ongoing trade war between us and China. So the other part that you want to look at here in China as well is retail sales. And I find this to be actually very, very important because, again, as you can see in 2008, it bounced around a little bit, but the overall trend is obviously down and to the right. So retail sales were still around 8%. It'll probably mature somewhere in the 5 to 6% range. So still strong, but decelerating. Now, the interesting thing with this is the trade gap between the U.S. and China has continued to widen, even though we have put the tariffs on. So the tariffs that were supposed to close the trade gap, nothing has actually, it hasn't worked so far. And so the reason why this is important is because if you look at the retail sales and how it's slowing and how the U.S. economy is doing relatively well, well, that means we are going to spend more. And again, that means we will, the trade gap will widen because we're in a little bit of a better place. So what does that all mean when it comes to the Federal Reserve? And I wanted to talk about this because there has been so much discussion on the Federal Reserve just within this last week. And they're in a very, very difficult position, mainly because you have strong data that's here in the U.S. You have weakening data in Europe and China. You're getting political pressure from the president. You're getting market pressure from a bunch of different participants. And where does that put you? Well, part of the Federal Reserve's job is to avoid asset bubbles. And we're coming off a time of unprecedented zero interest rate policy for a long period of time. And what happens is this can cause asset bubbles. It happened in the late 1990s with the dot-com bubble. It happened in the mid-2000s with the housing bubble. And so with this potential for asset bubbles, their job, because interest rates are still extremely, extremely low, they need to normalize it at some point, is when you compare, again, I'm going to compare these different time periods, but 1998, when you had that near bear market, it rebounded when the Fed cut interest rates. And what happened was stocks rebounded so quickly that it made the dot-com bubble even worse, and when it eventually crashed because of a recession, starting in 2000 and 2001, it became a very, very long and deep bear market because of the high valuations caused by the Federal Reserve. So that's another thing that they have to consider. Also, on the other part is the flattening yield curve. So I talked about that, and inversion is not good and usually means recession. We're very, very close to flat. So they don't have, even though interest rates are still extremely low, there's not a lot of room for them to continue to hike because that flattening could easily turn into an inversion. And then additionally, you have widening credit spreads, as I talked about. So there's a lot of different things that they have to juggle here. And I was actually, even though the market was very negative on what they did this week, I don't necessarily disagree with it because there is a lot of strong data. They're continuing to hike because of that strong data to normalize our interest rates, and that will in the long term be more beneficial by avoiding those asset bubbles. And so there's a few things that are going on, and they're going to have to remain data dependent. And I expect they may walk back a little bit of that language as we go forward, but realistically, if the economy remains somewhat strong and the job market remains somewhat strong, they have every right to continue to hike, and they probably should continue to hike. So if the data starts to deteriorate rather quickly, they can stop. So it's not as if those 2 hikes for next year are set in stone, even though the market reacted very, very negatively to it. So the next thing I want to talk about, now that we talked about the economy, is really a focus on corporate earnings and the health of what's going on in corporate America right now. And this is a very interesting chart on the right because it really breaks down the drivers of return in the stock market. And it breaks it down for every year. So the orangish box is the multiple, so what people are willing to pay for stocks. In fact, the multiples moving up and down is what really drives the day-to-day moves in stock markets, because the fundamentals don't change that quickly. It's really what people are willing to pay. The gray box is going to be the dividend that you paid, and the blue box is going to be the actual underlying earnings of the stocks of the companies that are there. So as you can see, if you go back to 2014, everything was fairly even. You had some multiple expansion, you had good earnings, and a little bit of a dividend. As you can see, actually, if you look at every year, the gray box, 2014, 15, 16, 17, and 18, the dividend is the one thing that's fairly consistent. It's fairly consistent every year, even if the multiple and earnings will vary. So if you look at 2015, which was not a great year for the stock market, you can see that the dividends made up all the return. There was slight multiple contraction and no earnings growth whatsoever. So no earnings growth, and we still had a slightly positive year. In 2016, we had again, coming off of 2015, big correction early on, and then we had multiples expand. We had EPS move higher and dividends stayed the same. 2017, you can see multiples expanded even more, but earnings were very, very good and dividends stayed the same again. Now, the interesting thing, the anomaly here is when you look at 2018, is earnings have been absolutely fantastic this year, but the multiple has contracted by over 20%. It's 25% contraction in that multiple. And so that has been the biggest driver of the downward turn this year, has been not necessarily the health of corporations, but what people are willing to pay. Now, the important thing to realize is stocks are forward-looking. So it's not what you did for me in 2018, which was very good, but what's going to happen in 2019. Now, there's a few different things that corporations do. They tell you that they make up the stock market. They tell you about the economy, and it is the earnings part of it is earnings and dividends are the most predictable and the things that you can forecast in the most predictable way. So when we want to look at multiples and corporate valuations, with what's happened over the last several weeks, you can actually see that multiples have dropped back down. They were expensive through basically from 2014 through last year, and they continue to get more expensive. But now they're back to an average level for a market multiple over a long period of time. So it's an average multiple. So they're not cheap, dirt cheap. They're not expensive. It's an average multiple. Now, the interesting thing in this chart is, do you believe the E part? Do you believe the earnings? So that is a very, very big component of what you want to look at. Do you believe that those earnings are going to be there, or are analysts, or is the economy going to deteriorate rather rapidly and earnings are going to get slashed? And so then you can't really pay attention to the multiple, because if earnings keep dropping, you can keep the same multiple and stocks will continue to drop. So I want to take a look at what to expect. So we're going to look here at corporate earnings. This chart, don't worry about the numbers. Really, the colored lines is what's most important. Let's take a look at forward estimates. Again, they're forward-looking. What are estimates saying for next year? So the blue circle and the pink line up here is what estimates have been for 2019. So as you can see, they actually started out okay. They moved up. They continued to move up, and they started to peak and are starting to come down now. Understandable. in 2018, they had come down for most of the year, and then you had the tax overhaul, and earnings estimates spiked dramatically and then moved higher through that year. Now, take those two out, and you go back every year. 2017 purple, 2016 orange, 2015 green. You go right down the line here, and in every instance, which were all good years in the stock market outside of 2015, you can see that earnings estimates started out higher, and through the course of the year, those earnings estimates came down every single year. So, and they came down, in the instance, the green line of 2015, those earnings estimates came down rather dramatically. In 2016, they came down quite a bit as well, but not quite as dramatically as 2015. So if you take a look at 2019, those estimates haven't come down at all. And while expectations are based on the recent price movement, these estimates would have to get cut even more so than they were in 2015 to really justify the multiple that we're paying on those stocks right now. So they have to be cut rather dramatically. And in order for that to happen, the economy would have to basically go into recession or fall rather dramatically. And as we showed earlier, I don't know that that's necessarily the case. At least the numbers in history are not pointing towards that. So you have the numbers, you look at the earnings, but sometimes you really need to get to look and dig in to what the corporations are telling you, because they will print their numbers, they will tell you what they earned this quarter, they can tell you what they're expecting next quarter, but a lot of times companies will give color because they are the pulse. They're the pulse of the economy. They know what's going on, and they know a lot more than anybody else because they know their business. That's how they thrive. So here's a few different things that have happened. So Nike last night, they surprised on their earnings by 13% and 2% on sales, and raised their guidance going forward for the next year. So again, and Nike is a global brand, so they have a lot of overseas where there's some weakness, and they're basically forecasting a better 2019 than 2018. So again, this seems pretty healthy. Now let's take a look at FedEx. They had a strong quarter for the third quarter, but they guided numbers down for the fourth quarter by 19%. That's a rather large cut. What they said on there was that it was weak international markets. So again, companies are telling you, FedEx is telling you there's some issues internationally. The economy is telling you that there's issues internationally, but it's not coming through on everything. And FedEx has some other issues as well. But again, two very, very large companies that are tied into the global consumer. One says something that's very, very positive, and one says something that's very negative. Next, take a look at Boeing. So let's look at another industry. Boeing just this last week initiated a new $20 billion stock buyback and increased its dividend by 20%. And that tells you companies don't increase their dividend in a time when they're expecting a lot of turmoil. They also don't come in and do massive buybacks when they need to be conserving capital and bracing for a recession. Boeing, again, a global industrial provider that is a bellwether for the industrial economy. And again, looking very, very strong. Next, we have Salesforce.com, which they are very in tune. So it's a software company, very, very in tune. They do CRM software, very in tune with a lot of business across the entire economy. Just 2 weeks ago, they beat earnings for the quarter by 21%. And in the conference call, specifically stated, the CEO, I see still several years of good, solid growth for the economy. So for a company, yes, it's tech-oriented, but very, very much tied to the business cycle, this was very refreshing. Now, on the flip side of that, you have Micron, which just reported this week and gave very, very weak guidance going forward. Hey, they had a good quarter, but going forward, they gave weak guidance, and again, related to the mobile phone. And what's interesting is when Apple reported last month, they stated that they were not going to provide guidance going forward on the amount amount of iPhone sales. So this is something that's known. There's going to be issues with phones. There's going to be issues with some type of, with FedEx, with some type of trade. But again, there's other parts of the economy, like the consumer with Nike, like industrials with Boeing, and just the general view with Salesforce. So I know these are only 5 different companies, but it gives you a snapshot of what you're seeing in corporations. There's some good, there's some bad, but overall, it's not as bleak as what the stock market is telling you. So next, we're going to focus on sentiment and positioning. And the reason why this is important is because it can tell you a lot about what the current views are in the market. And this, why this is important is because it is an indication of where surprises can come from. So when sentiment is very, very positive, there can be downside surprises. And when things are very, very negative, there can be upside surprises. And sentiment is just one part of it. There's also positioning and how people work. So my example for this is when sentiment is negative, it causes investors to position short the market. If there's a positive news surprise, then all the people that were short, now they're caught and they have to buy into the market. And because they're short, they have to buy into the market, and that moves the market even higher. And so that's why it's important to take a look at these things. And I believe this is a lot of what's going on in the market right now, because the fundamentals just, while they are slowing, they're just not portraying a down 20% move in the stock market in 8 weeks. So let's take a look at where we sit with the current sentiment. This is the Fear and Greed Index, which basically just, there's a lot of different measures to say where sentiment is. Greed, obviously, is extreme greed, means people are feeling great, and extreme fear is they're feeling absolutely terrible. Now, the interesting thing with this is we're sitting at a 4 level right now. You can't get much lower than that. So there is extreme fear in the market. And if you looked at where we were a year ago, we were at 72. So at that point in time, if you think back, things, the market had a good year in 2017. We just had tax cuts. The economy was doing well, and everybody was excited. Well, guess what? This tends to be a contrarian indicator. So when things are going really, really well, you want to take the opposite side that, or at least slow down a little bit. And when things are really, really bad, you want to take the other side as well, because when you have that much sentiment in one way or another, the only surprise can be really the other direction. Here's just a couple of other things too, and it looks at more investor sentiment as opposed to just overall sentiment. And as you can see, I mean, this chart can be a little bit choppy as it moves up and down relatively quickly. But the important thing to notice is here we're at a level of 24 where we sit currently. So only 24% of people are bullish right now. And what's happened is when you get towards that level, when it turns, we got there in 2016, we were below that level. But extreme readings tend to coincide with a turn in the market. And so while we're not quite yet at extremes, we are pretty low as far as the amount of people that are bullish. And on the flip side of that is the amount of people that are bearish. Now there's also people that are neutral as well, but it's more important to look at the ones that are bulls and bears. And as you can see, 47.3, not quite extremes, but pretty close to any type of non-recessionary environment. There's quite a few bears out there. And again, this is just to put a spin on where can you get surprised. And the bears can get surprised, and the bulls can get surprised. So right now, things, just like the fear is showing, sentiment is extremely, extremely negative. So next, this is something that I find very, very interesting, which is positioning. And where are people positioned? So sentiment is one thing, but if people aren't positioned in a certain way, then there's no way for them to take that opposite action. So this chart here takes a look at basically the big funds, the speculative traders, and their positions on the 10-year Treasury. So you can see from 2008 to 2016, it had moved. 0 is basically a neutral level. Anything above 0 means that they're net long 10-year Treasury. which means that they're expecting 10-year Treasury yields to drop. And anything below 0 means that they're expecting they're short Treasuries, and they're expecting interest rates to go higher. So as you can see, fairly stable for the better part of 8 years. After the election in 2016, they went very, very short 10-year Treasuries, expecting them to rise. And then throughout 2017, they covered those, and what happened was Treasury yields actually came back down. Now the interesting thing is, late in 2017, we had the tax bill that came through. So as the tax bill came through, we continued to get shorter and shorter and shorter till we got this massive negative short position through the end of the summer of 2018. And what happens is, because they're short, once Treasury yields start to drop, then they have to cover the short, which means that it causes Treasury yields to drop even faster. And so, because they were caught on the wrong side of the trade, and that's why positioning matters. So what's interesting about this is, when the stocks first sold off in October, the 10-year Treasury yield did not move much. We stayed around that 320 level. We stayed there. The stock market bounced around a little bit, and then it started to come down, and it went from 320 to 315 to 310. All of a sudden, once it broke that it was about that 3% level. It went from 3% to 280 very, very quickly, and that coincides with this change, this drop in that short position, because they had to cover that very quickly. And so that's why it's important to look at where the positioning is, because it shows where the risk is for big traders to be wrong. So the next one, it's not just 10-year Treasury yields, but here's a look at crude oil. And so again, 0 would be neutral, negative would be net short, and obviously the more positive you get. And since 2006, we really have had no times where traders are net short oil. And what happened is, but you can see, we got very built up into 2014 and dropped from 2014 to 2016, which again ended up causing the growth scare and the large correction in early 2016. From that point on, we had a massive move higher in positioning to a record long position early in 2018. And what happened, again, the positioning came down over the course of the year, and then all of a sudden in October, once that initial downturn happened in the stock market, all of a sudden they liquidated a massive amount of positioning. And that just so happened to coincide with the unwind of the 10-year Treasury. So again, you want to take a look at positioning. Where is the risk that some of these things start to unwind when prices go against you? And the last part of positioning that I want to look at is the bets on volatility. And this is important because the original correction in February was driven by a move against all the short volatility traders. So basically from 2005 up until around 2015, it was relatively stable around that 0 level. We were a little negative in 2014, but not huge moves. From 2015 down to basically the beginning of this year, there was a lot of positions that were shorting volatility and continued to move and become short volatility. When the market started to sell off in January, all of a sudden these trades became negative. And if you have a lot of people piling on a trade for years and they put leverage on it, they have to cover that relatively quickly, which is why you saw a huge turn went from massive record net short to a massive record net long volatility in a matter of a couple weeks, which again caused some liquidation and caused the correction back in January and February. The crazy part about this is, rather than just get back to a neutral level, the traders went right back, and this just so happened to coincide with the lows in the market in February. Over the course of the year, so what took 3 years to from 2015 to 2018 to put those short volatility positions. In a few months, we went right back almost towards record short volatility, only to have it go right in their faces again when the market started to sell off in October. So twice in 1 year, these volatility traders got absolutely crushed. And what happens is when someone gets crushed, they have to start finding other positions to liquidate. And that's the part of positioning that can maybe give you some insight as to why markets move as quickly as they do. So now that we went through everything, I kind of wanted to try to there's a lot of moving pieces and really try to put this puzzle together. So first off, 1987, the crash was caused by, there was new program trading involved, and there was a false sense of security from portfolio insurance, which caused a almost 23% crash in 1 day. In 1998, we had the Asian financial crisis, which led to the blow-up of a hedge fund, long-term capital management, where they were forced to liquidate a whole bunch of things, and it caused the very, very rapid market downdraft. And why do I keep bringing up those two? Because those are very, very large market downturns outside of a recession. And because the economic numbers are not showing a recession within the next 6 to 9 months, I really want to compare to other bear markets or almost bear markets without a recession. And where does the current backdrop send? So now we have computers and algorithmic traders, which basically use signals across many different asset classes to make very, very quick trades faster than a human. So what happens is what they're doing is basically they take oil or 10-year treasuries or stocks or gold or the dollar, and they put it into, and once they start moving, it can cause ripple effects through other assets. So the interesting part about this is over the course of this correction, downward moves in one asset have caused selling in others. So the first downturn happened in stocks, and then it moved to oil, which affected yields, which then affected credit spreads, which then affected volatility. And when you add all these things together, if you have people that are positioned in the wrong way and they have to cover, then they end up starting to sell a little bit of everything. So that's what I find most interesting about this, is it started in stocks. And for a human or an analyst, you try to get a view, and that's why you're starting to see these headlines. Well, if oil went down 25% that quickly, what is that telling you about the global economy? And now we've got yields that went from 3.2 to 2.8%. What is that telling you about the global economy? And credit spreads are widening. What is that telling you about the global economy? But the interesting thing is they didn't move until after stocks started to drop. So it's kind of that chicken or the egg thing, which came first. And that's why it becomes very, very interesting. So it's very difficult to say what actually triggered this initial sell-off because there has been so much negative press, especially politically. There's the trade war, there's the Federal Reserve, there's an ongoing investigation, a lot of things that I don't even need to rehash. But there's so many different things that have been in place for most of the year. Why did it all of a sudden happen in October? So it'll be a while till we figure out what that is. But the interesting thing is the extreme positioning in 10-year treasuries, in volatility, and in oil, I believe turned a mild pullback into a large correction very quickly as funds had to readjust their positioning very, very, very rapidly. And realistically, the only way to know for certain is in history. We'll look back and we'll see what actually happened. And my guess is that you're going to find out that a few big funds ended up blowing up at this time, and that caused a lot of this excess churn. So what does that mean looking forward? Well, basically, the economy probably peaked this year, but is strong enough to not have a recession in the near term. Corporate fundamentals are mixed, and valuations are cheap enough that stocks after this sell-off have become attractive. Sentiment is so negative that it can lead to upside surprises. Positioning has become negative enough that an upside surprise can lead to a fast recovery in prices. And bottoms can come at any time. And we still We still can go lower from here. This can turn into a bear market even without a recession. But without a recession, that downside should be limited. Doesn't mean we can't, we saw 33% in 1987. I don't think we get there, but maybe we get to 20, 25%. That can happen based on, just what you're seeing inside inside what the market technicals. That can happen, but if the recession doesn't come, then this downturn should be short-lived and lead to more upside. So really, it doesn't pay to panic at these levels, because if you panicked in 1987, you sold the bottom. If you panicked in 1998, you sold the bottom. And I don't think panicking right here is going to make sense either, even though I expect this volatility to stay around for some time. And what it leads me to is, when you take all of this together, don't panic on the downside. When you get your recoveries, take a look at your risk tolerance, look at what's available, and maybe make some asset allocation decisions at that point in time. And you have to follow these indicators closely, because they can change, and they can change rather quickly. So with that, I just want to thank everybody for being here today and spending the time. If you'd like any other information, please feel free to send me an email. Additionally, I did record this, so I can send you a copy if you'd like that as well. And really just, I hope this was helpful, and it was educational and puts a little bit of perspective into what's going on with the market. And with that, thank you very much. Thanks for spending the time today, and happy holidays, and here's to a happy and healthy new year.